Eric, this is the second in the Phenom series, and I think today we're going to have a deep dive into some of the gold juniors, gold miners, and then we're going to have probably a little look at some of the crypto world and how the two are actually very complementary. But before we kicked off, you've been mentioning these junior miners in gold as being the real nitroglycerine in this sector. Could you maybe explain how the junior miners fit into this overall gold and precious metals framework, where they are, and really what they are?
Yeah, good question. I think for a lot of folks, those stages of development, it's just like when you look back at any corporation, any growth company. You've got the seed stage, you've got the startup stage, you have the post revenue, post product stage, the growth stages, the late stages, the mezzanine stages. These are similar that you apply to the gold miners, and the bigger spot within the hierarchy are clearly the producers, the ones that are already mining gold and have potentially multiple mines. You look at larger companies like Barrick and Newmont and Yamana and these type of groups. They're already producing significant amounts of gold each year, and they have their pipeline of projects as well. And I'll get to that in a second, but they don't have enough because of the way that this market has essentially transpired over the last, even going back 2 decades. And then you have, so the producers are there, and that runs the gamut in terms of larger producers, and there's smaller, scrappy producers that are putting together, 20, 30, 40, 50,000 ounces a year. But those are considered juniors in many ways, and they are. It's about market capitalization at the end of the day for me, and or stage of development. But you also have a situation in the middle, which I like to call the development stage companies. International Tower Hill, what I talked about in May, was a company at a development stage, which means that they've already spent tens or hundreds of $millions finding a deposit, and then for whatever reason, they may be moving it forward into a preliminary economic assessment. Usually the development stages are that they've done that. Then they move on to a pre-feasibility, a feasibility, and then a decision on building a mine, partnering with somebody to finance the mine. Or in a lot of cases, and what I like to see is that those and the smaller juniors, they get bought out by the producers to replenish these reserves. With the supply of gold, all of a sudden, when you're looking at it, say, versus Bitcoin, the miners are just going to ramp up production, and it's going to be flooded with gold. Do you know how hard it is to get this stuff out of the ground and how long it takes? It's crazy, and we've seen this as a metric for store of value, and I'll get to the juniors in 1 second, but we've seen this be a stable metric of store of value because the gold standard wasn't perfect, but we knew that there was around a 3% maximum in terms of new supply per year brought into the market by producing mines and miners. And recently, as of late, I really haven't seen that over a 1.5 points. So when you look at a company that first starts to drill, this is where we go into the juniors, they drill and you're starting with nothing. You might have some data from prior, but by the time they build that up, that resource up, to get to a point where somebody has confidence in the stage, the geology, the size, the economics, by the time they do that and get it into an actual production decision, whether it's them or a larger company, it's over a decade. So when you've got a barren pipeline, especially what we saw, there was flow through in 10, 11 into the local top in the market. And then after that, with such a nasty bear market, which we saw the worst in 77 years, going into from the top in 2011 into the absolute low in January of 2016. Yes, we got a big bounce and then another frustrating few years in there. So the majors have not replenished that pipeline. They had to follow through on what they did before, and they tend to scale back in those markets. The juniors then have opportunities if they can raise capital, they have good projects, they can stay solvent, because the juniors there's no revenue. They're just, cash is just going out the door. The question is, what are they spending it on? What do they have? What's the value creation? But the juniors, they're really just called junior exploration companies. And that essentially means that they're out there looking for gold. They're looking for the metal. They're looking for deposits that are economic. And then if you want to go down the risk spectrum, you go from the producers to the development stage companies to the juniors. In Canada, it seems to be the junior mining penny stocks. Because that's where all the juice is. And a lot of these companies shouldn't even be public. We're talking about, $5 million, $2 million, $8 million, $12 million market caps. But I love it because we can find some gems in there.
So, Eric, we've obviously you covered the sort of broad spectrum there. We're going to look at some deep dives on some individual names later in this space. But obviously, one of the key elements here is the macro backdrop. Because remember, we all got excited. It was really 2 years ago, and then particularly last year, with this whole fiscal and monetary, and particularly with everything that went on with the pandemic last year. We've had some conclusions, you could say. We've now had an election. We're getting an indication of who will be the Treasury Secretary. What do you think this is going to mean for the fiscal and monetary? Because that fiscal and monetary outlook, that loose fiscal and monetary outlook, was one of the sort of big drivers of a lot of excitement in this space. How do you think that's going to set itself up through 2021?
Well, I mean, I hate to say this, but, because a lot of people, it may be a little bit too flippant, but it doesn't even matter. I came out with a video in, I believe it was September, October, because I had heard so many folks that were waiting until after the election to do anything, and I said, fine, I get it. It's certainly going to affect global markets on a short, possibly intermediate term, but, the short term, there's always reactiveness to what ends up being a conclusion. And, the reality I said then is that our core focus, which has been gold, silver, Bitcoin, areas where we feel that we can either maintain value or get exceptional value and gains. When you look back at President Obama, then you have, you can look back even towards Bush crossing over, certainly into the 08-09 timeframe. When you look at from there is when we saw this hockey stick of money creation to save the system. We've seen deficits and debt explode, and they've always gone up, but these have been increasing in trajectory, and that is a lot of that stuff has been going on the monetary side that whole time. We've had QE and things that were out of the headlines, QE3, and they would still be doing bond buybacks, buying our own bonds we issue, and all this crazy stuff that floods the system with a new fiat, essentially dilution. I mean, if you keep it really simple and want to talk about inflation, deflation, what's next, what's coming, I don't even get into it, because I don't know. My thesis, though, is that when you look at the timeline in the U.S., and really this is a global issue, you look at Europe and everywhere else, how can we stop? How can we stop stimulating on both the monetary side, which has really carried the ball up until now, and now you have the fiscal side, which has had to step in, and they really haven't done much here. I mean, you look at the $1,200 check everybody got, that lasted everybody a really sweet 3 days. That if the stock market, say the S&P, is up 9% 1 year, then everybody looking at their 401ks and mutual fund performance, yay, good year in the stock market. But what if the currency in which you invested in was down 13? Okay, so you have that metric and you've lost 4%. That doesn't even include the fact you're going to pay taxes on those gains and other situations. So you have to look at that, I believe, to get an accurate viewpoint of what's really going on with these asset increase prices versus all the different layers. And I would say I price those things at the end of the day in gold.
I think it's very interesting there, Eric, that you talked about Bitcoin and gold, because it's been a very visceral discussion for a lot of people, but you've got a much more balanced view. I think before we go into that, because that's a key part of this discussion. Last time you mentioned a couple of these junior gold miners. You wanted to just touch on again as two that you'd picked out, International, Tower Hill Mines, and McEwen. Could you explain what it is about those two that you think have such star quality?
McEwen Mining, which is a producer, a mine producer. I believe they have 5 that are happening right now in North America and South America. And essentially with McEwen, you've had a turnaround scenario that has taken longer and been more expensive than I've thought, and Rob McEwen and the group behind McEwen have thought, in terms of just startup issues at or restart issues at one of their main mines at Black Fox in Canada, the depletion of one of their mines that was there for years. This is a nominal part, El Gallo in Mexico. But then also the Gold Bar project in Nevada was a mine startup. And what tends to happen, and this is right to the point of, like, if you think that somebody can just flip a switch and have more gold into the market, go talk to McEwen Mining or any of them out there, how difficult it is, the cost overruns, the problems that come in with the engineering stages to build the mine. And I think with McEwen Mining, they've had the definite worst of that out already. They already did by May, and it's really just kind of drug on a bit longer before the operational, I think, turnaround really kicks in. So I see a lot of torque and upside there. Really beta, because if you look at McEwen, this is run by Rob McEwen, who is the CEO and chairman. He calls himself the chief share owner. He doesn't take any salary. He owns over 20% of the company that he cut, but it's close to $175 million in checks. And his cost average, he has bought more in the open market in the last 3 to 6 months-ish. His cost average is in the high ones US. And right now, I believe we're right around that, below $1 US. And when I recommended initially here, it was around 70 cents and a little bit lower, and it had doubled in the weeks following. And that was just, that was a small little, spike re-rating. It's faded back with the sector. But you're talking about somebody who, during the 90s into the early 2000s, when gold was in a terrible market, Rob McEwen started when it was a $50 million market cap, Goldcorp. He came in, he essentially did some very unconventional things, and they had found in the Red Lake district an extremely prolific area that became a very profitable mine for Goldcorp. And he did this in a time frame where not only was he coming in at a very small junior stage, but so he grew this with drilling, connecting the dots, taking it in as a producer, a driving producer, but basically acquiring other assets, acquiring other projects, putting stakes into other companies. He's a very good quarterback in that way. And his compound annual return at Goldcorp, I believe it was a little bit less than a decade, maybe around a decade, 28% a year. And that was in a very bad market from the late 90s into the early 2000s. Only at the end did he get any real tailwind from that. And so that is a play that I'm banking on for the longer term secular bull market, where McEwen will play catch up with the sector because it is underperformed, and that will add some beta to the portfolio. And then eventually, what it has done in several cycles, going back into the late 2000s, it's always been a very high outperformer of the GDX. International Tower Hill it's a different animal in the sense that this is a massive deposit, of a gold-only deposit, the biggest in North America, in Alaska, called the Live and Good Project. And when you look at some of these stage companies and assets, I just look at them versus, what is the price you're paying per ounce of gold in the ground. And that could be, there's different stages that you have to prove up to call them certain categories. Starts with inferred, then you have measured and indicated, then you go to proven and probable reserves, and move it up the ladder. The more you have the proven and probable stage, which is at the end, there's been a tremendous amount of work done on that. These are things that really should add to the ultimate valuation of dollars per ounce that are reflected in the market value of the company or in a buyout. And International Tower Hill was at $100 million market cap-ish US when I talked about it last time. That was probably around 68, 70 cents, and McEwen maybe a little lower. And that stock, they added $250 million to that market capitalization within about 7 weeks after that. And that was, just people learning about it. It was a stale story from before, but that deposit hasn't gone anywhere. And they've been doing work on it, and they have Paulson and Co., Electrum Group. I mean, these are substantial shareholders that they're patient. They make a lot of money over time. We know that. Certainly in this sector, they've got huge financing behind them, but they really just have to wait. They had to wait for above $1,500 gold to be in the conversation because of the economics of live and good. We know that. We've known that. And really that leverage, if and when gold does go higher from here, could be extraordinary. I talked a bit about the NPV torque that's there. Even within their presentation online, you can look at the PowerPoint and the studies. It's insane. From $1,700 gold to $2,500 gold. Those numbers, I don't have them offhand. Again, I would have to watch the video again or look at the PowerPoint, but it's in the 20x plus NPV growth. It's very, very substantially higher than the price of gold because of that. All of that stuff falls to the bottom line once you get over a cost basis for any of these miners, and it can improve things dramatically, and that's where you get the leverage in the miners versus the gold. And nothing has changed with International Tower Hill except that it's a bit more expensive than May, and it's not anywhere near as expensive as it was in June through August. So I like them both.
What does that in terms of translating to the potential upside for these stocks? Because when people are thinking about these, and we're talking about these as being that bit of the portfolio that's going to perform really, really well in these bad times, and potentially the other parts. What sort of returns were typically historically expected, and sort of can we maybe expect in the future? Are these kind of 5x, 10x, or more or less?
And especially when I go down the chain. And I put out some analogies just to what McEwen had done from bottoms when it was first started in 2006. It went to $10 from below $1. That was just when Rob came in. The shell put 3 projects in there, no producing mines. The 08-09 situation, 38 cents, I still believe, is where I got my last low tick as a broker. $10 by end of 2010. And then we saw in the end of the bear market in 15 into January 16, it had been way down again and had gone to $5. So that was, even in that case, you're still talking about somewhere in the 10x ballpark, and the others were greater than that. And now you've seen over all this time, they have substantially more assets, more advancement. They have to get a handle on the economics and the operations, but I bet that they will do so. I think that with McEwen this time, because we're at new highs in gold, it's the situation in 11 that's been busted through. We've had 10 years of work and money invested, and so I would expect that that $10 high we saw twice in the future will be broken by McEwen. So there's your 10x plus on that. But even just retesting those highs from a decade ago, more than a decade ago, you're looking at over 10x. International Tower Hill, their economics go through the roof so much with the price of gold between that 1,700 and 2,500. If we just go back to where we were, 22-ish hundred, it adds such huge value. And so if we do see, and there's going to be this direct connection, obviously, with the gold price, if you're a believer that gold is going to go to new highs, an International Tower Hill and or a McEwen, but in different ways and for different reasons, are incredible things to have allocations to in your portfolio, because that is where you're going to outperform incredibly the price of gold and different commodities or precious metals.
And the people love to spread their risks around a little bit within, even if they're going into a sector. So there's 2 names there. Some people say, well, I've got to be in more than 2 names. You talked about a couple other things. You talked about GoldX and I think it's Newfound Gold. Are those 2 names that you like? And if so, why? Because people will always be thinking, okay, I want to have my exposure in more than 1 name, probably more than 4 or 5, but obviously they don't want to have too many. So what other names are there on the radar at the moment that people can add to this portfolio?
I'm essentially presenting what I believe here on this series and in the prior video to be a very interesting hybrid of what has limited or somewhat limited downside risk profiles for various reasons, yet a lot more upside than you're going to get in an index like a GDXJ, a GDX for various reasons, or the producers or gold mutual funds. So GoldX Mining has a hybrid of what we just talked about: the people, the operators, the investors. From a McEwen standpoint, the International Tower Hill development stage, large asset leverage standpoint, and GoldX is also a situation where I just think this thing, essentially, when you look at, does it have the biggest upside of any juniors? Well, it doesn't, because the risk, the downside here, I believe it's very, it's lower than normal, much lower than normal, of companies at this market capitalization and whatever you're looking at, whether those are discovery plays those drive market values a lot when you're going through the discovery cycle, these development stage opportunities, and they have a lull, which is when they build all this out, what they pretty much have, and they have to move towards, getting into production, and then that's where the return profile kicks in. But with this situation, it's absolutely extraordinary. I find it to be probably my favorite risk-reward situation when you balance it out. I mean, we all know that if you've got something that's going to possibly go up 10, 20, 50x, there's a lot of risk. There's a lot of risk for volatility. There's a lot of risk for God knows what. There's usually a very similar correlation. In this situation, I don't see it going up that much, but it still has the same upside as, to the price of gold and leverage than others. And you have, in a downside scenario or in that scenario, on the upside, you have operators here who are substantially good, and their track records show they essentially always, but certainly there may be some failures I don't know about, always create major shareholder value. And what attracted me here was, first and foremost, you have a chairman of the board that you just don't see anymore coming into a company of this size, and that's Robert Friedland, who has an amazing reputation in the business, going back to the 1990s, where he created such a massive amount of gains and shareholder returns in a very brief period of time for shareholders in a company called Diamond Fields, which had stumbled upon. It was like, you look at the luck in this one. There's a great book called The Big Score by McNish, and it's about the Voisey Bay hustle. It's my favorite, certainly mining investment book, or just mining sector book, but also one of my top 3 investing books. It's amazing. And when you look at what happened there, Robert Friedland had been, coming off of some problems with Bre-X back then in the sector, which polluted the whole sector, the taste for, producing these metals because of a really bad spill. And basically, when you look at what he did, Diamond Fields in November of 1994, when they first stumbled upon and started to hit very high-grade nickel in the Labrador area of Canada, they were trading at about $4 per share. And 1 year later, it was at $100. And then in mid-96, so you're talking about less than 2 years, not much more than 18 months, sold for $170 per share. And that is a scenario where, and by the way, that was $4.3 billion. And Robert, being the largest shareholder, he made a fortune. And from there, he's done nothing but run, operate, and own substantial mines all over the world, north of $10 billion market caps, because, you look at the best operators. I wouldn't look at him as an investor, as an operator. He's pretty much, I believe, sort of the king in this space because of his successes. So him as a chairman, really, I was like, what? He's here in a $130 million US market cap scenario. Why? But I refer to the Diamond Fields situation because he created a bidding war early on in his earlier days where he hadn't done this before, but he played the majors against each other and drove that stock higher while managing the drill program with the geologists and targeting and expanding this massive high-grade nickel deposit. And from there, we go down a notch to the CEO, Paul Matisek. Paul Matisek they're friends, and probably why Robert's involved. But whatever the reason is, Robert likes it, puts his name attached to it, owns shares in the company, and basically these guys together. When you look at even Paul's background, he hasn't had the $4.3 billion one company return profile, but he has created over $3 billion Canadian of shareholder value over the last just over a decade. And those are from coming into either building a company from the ground up, or basically having a situation where it's turnaround-ish situation, and that would probably be in the realm of GoldX. And he sold 5 companies. He's the quintessential operator that you want running a business like this, which there's so much low-hanging fruit, but it took time to clean it up. Now he's been there about a year, almost a year, at the helm, and the capital structure cleaned up. The everything. He's taken the time to methodically create the runway to build this valuation up, create value, and probably divest the company and or the asset. And I don't think they're looking to wait 5 or 10 years. This is an opportunity because of the stage of the Torokuru asset, which is the main asset that they have, which is you've got over 7 million ounces of measured and indicated already, and this is in Guyana. So sounds African, but it's in South America, and it actually is. The IMF says they're going to be the fastest growing economy in the world this year. I believe last year they may have been right up there. So in any event, and the political risk side of it, it's pretty well understood. But when you look at the size of that, and then there's another several million ounces of inferred, that lower category, and a market cap of 130 million US today. And I'm going to say the Canadian price I last saw was just under 3.25, which is GLDX on the Toronto and GLDXF in the US. And these guys there, as well as one of their investors, Frank Jusra, who owns just under 10% of the company, he's also a value creator from, essentially a mining small investment banker, investor back in the heyday in the 80s, building up, several firms going outside of that, Lionsgate Entertainment, and, he's a multi-billionaire. So the 3 of these would be different from, for example, you look at like an Eric Sprott, who was a portfolio manager. And these folks, though, they don't do that. They don't spread themselves wide to get sort of a venture capital, let's hit 1 or 2 or 3 out of the park and it's going to pay for all the losers. They get involved heavily in deals and they straight up make them work and they see them through. And when you've got 20% of the stock is held from insiders and family members, etc., you've got Wheaton Precious Metals with just under 10. You've got Gran Colombia with 20. You've got other elements here that essentially you're talking about 2/3 to 3/4 of this company is in the hands of very strong institutional and insider folks. So GoldX, there's a lot more to the story, but I think that when you look at the valuation of some of the companies that, just to quickly wrap up with NPV, and you take the companies that have been acquired in, the Americas, basically, undeveloped gold deposits, and you look at 3 of the largest ones to go through. 2 of them were acquired by Zijin, which is the Chinese national corporation, and you take the cost or what they paid for ounce in the ground reserves was around 150 per ounce, which right now that would put GoldX well above $1 billion buyout today, and that probably more because those were done at lower gold prices. And right now at that 320 Canadian, $130 million market cap. So that is one point. And the last one I'll make is that when you look at the NPV juice, as I like to call it on this one, they had done studies prior where you're looking at $1,200, $1,300 gold because it was more appropriate. But now when you look at the scale, the financial metrics on their PowerPoint, you've got an NPV at 1,900, by the way, which is pretty much where we are. with a 5% discount at $1.3 billion. So that would, essentially, and then you're getting into the 40% plus IRR level, a year and a half payback on the entire capex. And, when you go down to the 1300 level, which a lot of companies can't do this, you're still looking at over a 20% IRR, which it clicks all the boxes. And then Newfound Gold, symbol NFG in Canada, this company's got it all, and it really comes down to, I believe it's the most exciting new gold discovery play. I don't know if it's in the world, but it's in North America, I think, in terms of anything I'm missing. I know a lot of these bigger, more exciting projects, and I don't see anything like it. And there's some reasons for that. It's very unique. And the biggest money I've ever made in the mining sector in the juniors is getting in early on in a new discovery. And as they build this out, that's why Voisey Bay went from 4 to 170, and Friedland was a big part of that. But it's because of the drill results, the expansion of this exciting new deposit that we didn't know was under the dirt before. And so discovery plays, getting in at a certain stage and riding that expansion is how you make the most money in the space. And Newfound Gold is an extraordinary story in that Colin Cattell, who's the chairman, young guy, very impressive. His family was in the business, and I think he learned about this certainly at the dinner table when he was a kid, and he's taken the ball, and he's just really ran with it. He's very experienced. I don't know how old he is, 30s, mid-30s, young 30s, but he's done an extraordinary job here. And I think his inclination to go look for something big that they could consolidate, something that could be massive, was started in 2015, which is the perfect time historically, almost I think any time that you would look back at this marketplace. And it was because of the brutal bear market that we were in. The duration was sort of ending, but so everybody was on their heels or just falling off the cliff. And he went shopping. And he not only went shopping, he went in an area that you would have to consolidate because people know there's a lot of gold there, which is in Newfoundland, eastern Canada. And they have a great mining, it's a jurisdiction for miners that is great. You're not going to get people opposing you for drilling and mining for gold. So he went and consolidated. I believe there was 8 or 9 option holders on this package called Queensway, and got that done, formed the company, financed it, took it in little steps, drilled a hole, did samples. There was visible gold. He mentioned what was so encouraging is that there was visible gold all over this project. It was the first time that he panned gold. That's kind of rare these days. And, it's very close to infrastructure, international airport, Gander, checks all those boxes. But what's incredible is that they moved this forward so quickly in just the last, call it, year and a half, where they got some financing from 2 familiar names, Eric Sprott and Rob McEwen. They put the first chunk of dough in because they're on top of this space, and they gave them another big chunk. And there's another part of this story that actually weaves into how Eric Sprott became a multi-billionaire through Kirkland Lake, which has happened just in really the last 5 years. And it's fascinating. So that financing leading into, it'll be a year, I believe, in March, so coming up, they drilled their first hole at the Keats Zone. This is one area within Queensway, and the first hit was 19 meters of basically 93 grams gold. That's an extraordinary hole. And so that, starting it off, number one, is insane. And so they dug deeper into the actual geology here, which is something that, I rely on people that are the best here because I'm not a geologist. But Dr. Quinton Henning, there's no coincidence here with where the money, follow the money in this case, okay? So Dr. Quinton Henning, who's involved in many different big discoveries, was, I believe this is very accurate, was petitioned by Eric Sprott early on in the discovery of the Swan Zone, which is at the Fosterville mine in Australia. The Fosterville mine in Australia was a mine producing for probably almost 2 decades, barely breaking even, barely profitable, losing money, boring situation. I remember I owned the company that had it called Crocodile Gold a while ago, probably over a decade ago, and watched the evolution, which was they ended up being bought out. A company called New Market took over, and this is probably around where they went in a different direction. They were looking at that old asset, that old deposit, and putting some new angles, chipping away, moving it forward. All of a sudden, they end up finding this swan zone where just so you know, Fosterville is the most profitable mine on earth. And it's because of the swan zone, which is also what it looks like exactly here at Queensway with the Keats zone and several others. It could be much bigger, and it's very early. And when you look at what they found at the swan zone back in the day, they didn't know about this type of geology and what was happening with the rocks and how big and fruitful, big in terms of profits. It doesn't even have to produce a lot. When you're producing an ounce of gold all in, sustaining cost of 150, that's pretty darn juicy. I mean, you don't have to produce a lot of it to just flow cash out. So Eric was a big shareholder in Newmarket, also in Kirkland Lake, which KL, look at it on the NYSE, it's a $13 billion corporation. Some folks call it the Apple of gold stocks because of how amazing this has been developing and the wealth creation and the profitability of this from the Keats zone. And essentially, Eric looked to merge the two. When he had these initial signs of this change in dynamics, he petitioned and asked Quinton Henning to go check, who had also been working on projects of a very interesting nature in Australia. And so they started from the ground up and decided to buy this out before people really knew that the snake was out of the bag, so to speak. And that is what has created. I don't know the number that Kirkland Lake started at offhand when they bought out Newmarket, but it was around probably $1 billion or less. Now 13 billion, and this was just like 5 years ago. So that would anybody who says that they could mimic the swan zone at Fosterville, much less already these guys at Newfound, okay, they first began a 100,000 meter drill program, which kicked off in September. They've been knocking these intercepts out of the park all over a very, very large property that Colin and his partners condensed. And there's just so much upside. And from what they've been seeing, they recently, earlier this month, they doubled it to 200,000 meters. To give you an idea, when we have a small junior that's going to do a program, and we've only got $1 million, $2 million or something to pop some drill holes, you're talking about 1,500 meters, you're talking about 2,000 meters, you're talking about somewhere in that ballpark. This is 200,000 meters. Luckily, they have over 67 million in working capital. They have this within their budget to increase it without dilution. It's completely solidly financially backed, tightly held. When it came out as an IPO, literally just last summer, they had such incredible interest. They ended up turning down over $50 million in the IPO. It was very, very truly oversubscribed because what you saw here was not only Eric Sprott and Rob McEwen very early on, but then you saw Quinton Henning through his corporation, Novo Resources. I haven't seen this. I don't follow Novo super closely, but I haven't seen him pull the trigger on a $15 million investment through the corporation into Newfound Gold because when he looked at the rocks between these two, and there's videos on YouTube of him talking about it and other presentations, they're identical. And so if anybody's going to understand the writing on the wall, it's Eric, Quinton, and those folks that made billions of dollars. And it's such a rare event. When you dig deeper into the story in terms of how rare this event in terms of the geological setting is around the world and the fact that they found potentially the same, but potentially, it still has to be drilled out, larger situation all the way across the world in two separate events. It's very interesting. So Newfound, just to keep it pretty simple, these guys are in the beginnings, and there's a backlog on a lot of those drill results. they're in the beginnings of what could be the biggest, most exciting gold discovery on planet Earth in a long time. And so what happens with evaluation during that time? There's no limit to how high it can go. This is an exciting play. It's trading around 3.5 Canadian right now. We were lucky enough to identify it, start taking a position in the 170 area Canadian, so we're up 100%. Bought more recently, around 3, topping off a position because of how this is developing, and sky's the limit. So that's your exciting one with huge money, smart money, great operators that's there with blue skies. And then you've got GoldX, a lot of similarities in terms of the legends of the business, operators, investors, and a huge asset to basically monetize. So I like the mix.
And one of the things you've been talking about throughout, and it echoes from your first episode, is you talked about these being the really big play in the gold space, and the only ones that can keep up with some of the returns people will get in the crypto space. And the reason why I wanted to look at those comments and bring them in here is kind of twofold. One is your comparison of the two, because you see them very much as complementary, and in fact part of, in some ways, the same framework. I just wanted to draw on my own recent experiences, because I've sort of been someone who's not really had that much to add to the Bitcoin and crypto space. But something I looked at the end of last year is that in terms of data usage on platforms with Bitcoin, when it got to 20,000 just before the end of 2020, compared to 2017, data usage today was nowhere near. So there just wasn't that froth in the retail. Yet at the same time, I think this is in some ways key, is that you look at the Bank of America surveys and Bitcoin's in there, and it's sort of 4th, 5th, or 6th in terms of what might outperform for 2021. There's this sense today that there is some adoption in the institutional space for the crypto world and Bitcoin. But what's actually fascinating is that these are both still markets where, if only a small percentage of institutional assets come into either of them, it could have a massive outsized move. Could you maybe put that whole in that sort of context of how you see crypto and gold being complementary, being almost part of the same sort of framework, and maybe some of that institutional opportunity or potential that could lie ahead of us?
The situation overall for both of these, you nailed it in the sense that the overall global allocation by portfolio managers and asset managers is very low. It's been very low with gold. It's increased in the last year to a level that is probably, I haven't looked super recently, but we're still around percent ish. And so that, even being increased by 0.5%, is such a massive amount of flows into what's a pretty good sized market, 13-ish, $14 trillion, certainly, but into the mining space, there is, I believe I have to re-look at my data, but all of the gold mining sector put together is something like a bit more than Apple and or perhaps Amazon, and that's it. It's very small. So when you're talking about the money flowing into gold, that will have the intended effect in the sense that as a store of value and as a lower risk, lower reward scenario than both the junior miners with the leverage and also the downside. You have to look at, it's the same correlation both ways, which is why, when we saw with the juniors through that bear market, many of them were down 93, 95%. Some went bust, when the price of gold went from 1,900 down to 1,050, 1,100. So, it's a very big difference, just like, and not as big of a difference, than Bitcoin, in the sense that Bitcoin was down in that last collapse, 85, 87%. And then the altcoins, many of the altcoins, the smaller ones, they were down 99.5, 98. So when you look at the money coming into a big market like that, it will have the intended effect of being a store of value and likely gains on top of that, depending more or less on what your currency is doing. That's why I price fiat currencies, not, when you look at the dollar as the strongest out there against other fiat that are all being debased, okay, I'll take it. I'm an American, but what's it doing against gold? But in any event, that could really move certainly that market, definitely the junior market, which could pop like popcorn with a small movement of allocation. And I believe it's going to, the timing is a little bit tough on when it absolutely explodes, but we've made huge money over the last couple of years. And it's the area when I look at the cryptosphere, Bitcoin will do what it's intended to as well, but they have the same general drivers. I mean, Bitcoin was created, whomever Satoshi was created based on the model of gold and gold mining. Okay, so let's pay attention to that. That you look at the ability for it to be quote unquote deflationary with a fixed float, and it's a global potential asset. I mentioned this in my last video. It's like a low float, globally branded, relevant to everybody penny stock that is like new money in gold. So it can go up, and we're seeing that now. It's more of like, putting a fire hose in your mouth, and it's just, I think we've just seen the beginning of what's happening in Bitcoin. But gold's not meant to function like that. So when you look at the size of the markets too, Bitcoin still being where it is, it's not even a multi-trillion-dollar asset yet, well under $1 trillion. It's $1 trillion for the entire space, but gold is 13, 14 times bigger and essentially has a much longer track record. So I'm involved in Bitcoin for people talk about it as a store of value. It is not a store of value. Why would I want to put money into a deal and a situation, a technology that is so new and so incredibly volatile and filled with risk and unbelievable abilities to shake me out and make me run and FOMO into it at highs? Why would I do that unless the upside was absolutely venture capital-like, and in this case probably on steroids? It'll be a future store of value. But do you define things that go up as much as it's gone up since it was created, or any 2-year period? Things that go up hundreds, thousands, tens of thousands, million+%. If you look at Bitcoin from the early days, even more than that. Is that a store of value? I don't really think so. When I make 10 or 20 or get lucky to go above that in the junior miners, I don't look at those correlated to a store of value. The Bitcoin story, if it was a store of value, which it will, I think, become when it's millions of dollars of Bitcoin in the future, that's the future story. Gold is that now, and they're very complementary for me. But the institutional flows that are happening there, we're seeing the writing on the wall. I mean, the names have come in, and it's gone across the spectrum. Everybody from, when you see Mass Mutual put a $100 billion Bitcoin purchase out as a press release, all the way to some of the best fund managers on planet Earth, to corporate balance sheets, being put publicly traded, multi-billion-dollar companies that have put their balance sheet cash into Bitcoin. I mean, it's a different animal. It's very different than we are seeing in 2017, 18, and there's no supply. So when I look at that and I look down the pike at the altcoins, because all I can tell you is from my experience, the biggest money I've ever made in my life has been in these two areas. It's been in tech-ish venture capital. Really, a lot of that has happened in the last few years in the altcoins, the tokens. I also have equity investments like traditionally in those companies, but those alt tokens are where I've made 10, 15, 30, 70x in the last several years, and the juniors are the same spot. And the juniors, they really haven't gotten that, and also I think the altcoins will, but these are the two areas to really zero in on if you want to make huge returns and can understand the risk reward part of the market. They're both very attractive.
Eric, well, thank you very much. I look forward to revisiting some of those names, the smaller names, the ones that have the bang for the buck. But great having the chat. Lovely to hear your views on those miners. And I'm sure this is a subject that we'll revisit many times over the course of the series.
Thank you, Roger. Appreciate it.